Usually when you decide to build a house, there's a very clear expectation of sequence, right?
Yeah, absolutely. It's like a mechanical blueprint.
Right. You pour the concrete foundation first, you frame the walls, and then, you put on the roof.
It's totally sequential. I mean, you finish one phase, and that provides the stability for the very next one.
Yeah, you do step A, and it inevitably leads to step B. And honestly, it's comforting. We really like things to be structured like that, to follow a known formula.
We do. We crave that predictability.
But imagine you were halfway through framing the walls of this house, and suddenly the concrete foundation just starts dissolving into sand right under your feet.
Oh, man. That's a nightmare scenario.
And it gets worse. While you're staring at the sand, the bank calls and, forces you to buy the empty lot next door at top dollar.
Right. Out of nowhere.
Out of nowhere. And simultaneously, the price of lumber spikes by, 400% overnight. Suddenly, that sequential, safe blueprint is completely useless.
Yeah, that is a terrifying house to build. I mean, it's the absolute definition of a structural collapse happening in real time.
And that terrifying house is exactly what is happening to the American wealth trap right now.
It really is. The foundation is shifting fast.
So today, we are tearing down the blueprint to see why. We're doing a deep dive into a startling source document that decodes exactly why the traditional financial promise, go to school, get a good entry-level job, max out your 401k, and smoothly retire, why that promise is quietly breaking down right before our eyes.
And more importantly, how you, the listener, can become a deliberate actor in this new environment.
Exactly. Rather than just being a passive victim of a system that is fundamentally changing its rules.
Because the data we have from the source text is profound. As of today, June 10th, 2026, the implications for anyone holding a job or a retirement account are massive.
They really are.
But the mechanics of what is actually failing, they're largely hidden from public view.
Okay, let's unpack this. Because I'll be honest with you, I consider myself naturally curious, but when it comes to the deep mechanical plumbing of the financial system, I can get a bit lost.
Sure, it's incredibly opaque by design.
Right, and I've always just trusted the blueprint, so I need to start with the absolute basics here, because for my entire life, the path of going to school, getting that first job, diligently putting money into a 401k, and just waiting for retirement, I thought that was bulletproof.
Most people did.
So what exactly is the wealth trap, and why is that foundation suddenly dissolving into sand?
Well, it's falling apart because the very foundation of that blueprint, the wage-based economy, is basically being systematically dismantled.
Systematically?
Yeah. And the reason most people haven't noticed yet is that it's not just like one isolated thing breaking.
Yeah.
We're actually looking at three structural forces happening simultaneously.
Okay, three forces.
And what's fascinating here is that they aren't independent. They're locking together to form a highly destructive causal loop.
Three forces all at once. Let's name them first, and then we can get into how they lock together.
Sure. So the first force is the displacement of the career pipeline by artificial intelligence. It is fundamentally altering the labor market.
Right, the AI boom.
Exactly. The second force is what we call a money illusion. This is AI technology begins taking over the entry-level foundational jobs across the economy. Because those jobs disappear, wage growth for younger workers, and the middle class just begins to stall.
Because they can't even get on the ladder.
Right. Many simply cannot find that crucial first professional job. And when people make less money, or they're forced into lower-paying gig work, they inevitably reduce their contributions to their 401k plan.
Well, yeah, because you can't invest disposable income if you don't actually have disposable income.
Yeah.
You're just trying to pay rent.
Exactly. Now follow the money. Those biweekly 401k contributions from millions of American workers, they're the primary engine of passive index funds.
The automatic money just flowing in.
Yes, and those index funds are what mechanically, automatically buy up the stock market, propping up the massive valuations of the very AI companies that are displacing the workers in the first place.
Wait, wow.
So the technology destroys the wage base, which eventually starves the technology companies of the retail capital they need to keep your stock prices artificially high.
It's like an engine that's eating its own fuel line.
That is a perfect way to visualize it.
Because the AI was supposed to be this incredible catalyst for massive market value, but it's simultaneously destroying the everyday workers who actually buy the index funds that support the stock prices of the AI companies. It's cannibalizing itself.
It absolutely is. The engine cannot run if it digests the very mechanism that delivers its fuel.
Wow.
And while that slow starvation is happening, the third force, inflation and rising interest rates, acts like a vice grip.
Squeezing the whole thing.
Right. The rising rates mathematically compress the sky-high valuations of these tech stocks, while foreign nations are dumping U.S. treasuries to pay for expensive oil.
Which pushes our interest rates even higher.
Exactly. Regardless of what our own Federal Reserve does, the entire system is trapped.
Man. Okay, which brings me to the reality of the people actually trying to participate in this economy right now.
The real human cost.
Yeah. If this whole vicious loop starts with wages and jobs, let's look at what's actually happening on the ground with people trying to start their careers.
Let's do it.
I keep hearing about AI taking jobs, but my assumption was always that it just makes entry-level work faster, you know? Like it makes junior employees more efficient so they can do more volume. Why are recent college grads in so much trouble right now?
Because the fundamental nature of the entry-level job has completely changed, and the data from our source text shows the sheer severity of it.
How severe?
Well, since early 2023, entry-level job postings in the United States are down 35%.
35%. That is over a third of the entry labor market just vaporized in a couple of years.
That's a staggering reduction. By late 2025, the unemployment rate for recent college graduates, we're talking those aged 22 to 27, reached 5.7%, which is actually above the national average for all workers.
Which is wild for people with fresh degrees.
But the far more alarming metric is the underemployment rate for that same group.
Underemployment. Meaning what exactly?
The share of recent grads working in jobs that do not even require a college degree. That hit 42.5%. That is the highest we've seen since the absolute height of the COVID pandemic.
Wait, so almost half of all recent college graduates are working jobs where their degree isn't even necessary?
Almost half, yeah.
They took on the student debt, they followed the blueprint step by step, and they're like pouring coffee or stocking shelves because the entry-level professional jobs simply do not exist anymore.
The entry doors are closing. I mean, entry-level postings on Handshake, which is a major platform specifically designed for college students and recent grads, they fell over 16% between August 2024 and August 2025 alone.
In just 1 year.
1 year. A Stanford Digital Economy Lab paper from November 2025 tracked this closely. They showed that workers aged 22 to 25 in the most AI-exposed occupations saw a 16% relative decline in employment right after generative AI really spread across the corporate world.
That's a huge hit to a specific age group.
And Cornell University found that U.S. companies adopting AI reduced their hiring of junior employees by about 13% across the board.
Wait, I need to stop you there. I read that software developers in that 22 to 25 age bracket have experienced nearly a 20% decline in employment compared to their peak in late 2022.
Yes, that's accurate.
But aren't software developers the people actually building the AI? I mean, learn to code has been the ultimate economic safety mantra for the last 10 years.
It was the mantra, sure. But generative AI is exceptionally good at writing basic boilerplate code. And this points to the fundamental misunderstanding about how corporations are actually using this technology. The idea was that AI makes junior workers faster, so you keep them.
Right, augmented work.
You're realizing AI is a tool to speed up the bottom rung of the ladder. AI is capable of replacing the bottom rung entirely.
So they aren't augmenting the junior staff, they are eliminating them. But how does that work in practice? If you eliminate the juniors, who does the foundational work?
Well, we have to look at the historic purpose of entry-level work. It was never actually about the immediate high-value output.
What do you mean?
Think about a major law firm or an investment bank. The junior financial analyst did not write the most insightful market-moving reports.
Oh, it's definitely not.
And the junior paralegal did not argue the brilliant case-winning motions in court.
Right. Their early work was probably pretty rough. They were doing the grunt work. The senior partners were the ones actually delivering the final polished product to the client.
Exactly. The junior employees did the high-volume, rule-based, cognitively structured work. They reviewed thousands of documents during legal discovery. They cleaned up massive spreadsheets.
Why?
To build competence.
Yeah.
To learn the ropes through repetition.
Yeah.
But that specific type of work, the repetitive data crunching, the basic document review, the syntax checking in software, is exactly the category that AI systems handle most reliably and cheaply.
Oh, I see.
So corporate management looked at the cost-benefit analysis and didn't just make the entry rung harder to reach, they removed it.
This is so vivid to me. The source text actually has this incredible metaphor about the apprenticeship ladder.
Yes, the seed corn analogy.
Right. By cutting these junior roles, companies are effectively eating their own seed corn. Like, They're saving a massive amount of money this quarter by not paying 20 junior analysts, but they are creating a future where they have, as the text says, architects who have never laid a brick.
Which creates a profound long-term structural crisis for these industries.
Yeah.
I mean, think about it. If you refuse to hire junior employees in 2025 or 2026, where do your senior expert professionals come from in 2035?
They won't exist. There's no pipeline.
You need people who deeply understand the complex systems that sit below the AI abstraction layer. If an AI gives you a legal strategy or a piece of software architecture, you absolutely need a human who understands the granular mechanics of how it works to verify it.
Or to fix it when it inevitably hallucinates or breaks.
Exactly. If nobody ever laid the bricks, the building eventually collapses.
And it seems like this is fundamentally changing the demographics of who is actually losing their jobs. It's not the traditional story of a factory closing down and manual laborers being put out of work.
It is shifting the burden entirely. In August 2025, JP Morgan's senior economist Mirat Tashi noted something completely unprecedented in modern economic history.
What was it?
For the first time ever, workers from non-routine cognitive occupations, we're talking about white-collar knowledge workers, scientists, engineers, designers, corporate lawyers, they now account for a greater share of the unemployed than workers from non-routine manual occupations.
That feels completely backward from every economic recession I've ever read about. The white-collar workers were supposed to be the insulated class.
Historically, they were. White-collar workers have almost always led employment recoveries. They were the last to be fired and the first to be hired back.
Right.
But that historical pattern appears to be breaking permanently. Tashi called it an ominous sign for the broader economy.
But hold on. I watch the news. If things are this structurally broken for the working class and young professionals, why do the headlines keep saying the economy is resilient?
It's all about how you measure it.
Right, because the official unemployment rate is constantly touted as being historically low, around 4%. How can that coexist with everything we just talked about?
To understand that paradox, we have to dig into the mechanics of how the government actually measures unemployment. This is absolutely crucial to understanding the reality of the wealth trap.
Okay, ready.
The headline figure you hear on the news, which is currently 4.3% as of May 2026, is a very specific, narrow metric called U3.
Okay, how is U3 calculated and who does it actually leave out?
Well, the Bureau of Labor Statistics conducts a survey. To be counted as unemployed under the U3 metric, you must meet very strict criteria. You must be entirely without a job, you must be available to work, and you must have actively looked for work in the prior 4 weeks.
So, wait, if you've been searching for 6 months, you get depressed, and you stop submitting resumes for a few weeks to take a mental break. You are no longer counted as unemployed.
Correct. You completely vanish from the U3 statistic.
That's crazy.
You are now categorized as a discouraged worker. It also completely leaves out people who are working part-time involuntarily.
How does that work?
Let's go back to that 24-year-old marketing graduate we talked about. They apply for corporate jobs for months, find nothing, and finally take a 15-hour-a-week job at a retail store just to pay for groceries.
Okay.
Under U3, they are considered fully employed. The system sees them as a success story.
Even though they are deeply underemployed and nowhere near the career path they trained for.
Exactly.
Given that 42.5% underemployment rate for grads we just discussed, there has to be a massive shadow population missing from that 4.3% headline number.
There is. And the BLS actually tracks them, just not in the headline number. They produce 6 measures, U1 through U6.
So what's U6?
U6 is the broadest measure of labor underutilization. It includes all those discouraged workers, the marginally attached workers who haven't searched in the last 4 weeks, and the millions of involuntary part-time workers.
And what's that number sitting at?
U6, as of early 2026, is sitting between 7.9 and 8.0%.
That's nearly double the official rate.
Yes. That massive gap between U3 and U6 represents millions of struggling workers. And it gets even more concerning when you look at the labor force participation rate.
What does that measure?
This metric measures the total share of working-age adults who are either employed or actively seeking work. Right now, it stands at 61.8%, which is hovering near a multi-decade low.
Wait, let me make sure I understand the math here. If the participation rate falls, meaning people are just dropping out of the labor force entirely, doesn't that artificially make the U3 unemployment rate look better?
Yes, it does.
Because you're shrinking the total pool of people you're measuring against?
That is the mathematical trick of it. The U3 rate can actually go down simply because more people got so hopeless they completely dropped out of the labor force.
That's so misleading.
And the BLS is projecting this participation rate will continue to decline steadily through 2034, driven mainly by younger workers aged 16 to 24.
Because they can't get jobs.
Right. They are seeing the apprenticeship ladder pulled up. They are experiencing the friction of AI displacement, and they are literally just walking away from the traditional labor market.
It's structural displacement. People aren't just between jobs. They're being permanently pushed out of the system.
The data supports that. Long-term unemployment, meaning people jobless for 27 weeks or more, rose by 524,000 over the past year.
Wow.
It now accounts for 27.5% of all unemployed people. The source text heavily emphasizes this. This is not cyclical churn. This isn't people bouncing between jobs in a healthy, dynamic market. This is permanent displacement.
So if the wage-earning part of the American dream is stalling out this severely, and young people can't even get onto the first rung of the ladder to start earning and investing, what happens to all the money piling into the stock market?
That is exactly where things get weird.
Because this brings us to the second force you mentioned, the money illusion. If the everyday workers are objectively struggling, why does the stock market, especially the tech sector, seem like it is completely detached from reality? Are we actually as rich as our retirement portfolios say we are?
That is the multi-trillion-dollar question. And to answer it, we have to unpack the fundamental difference between wealth and money.
Wealth versus money. I think most people, myself included, use those words completely interchangeably.
Most people do.
If my brokerage account says I have $100,000 in an S&P 500 index fund, I assume I have $100,000. What is the difference?
The difference is liquidity and realization. Wealth is merely potential money. It is stored value that has not yet been converted into actual spendable purchasing power. The source text uses a brilliant physics analogy to clarify this. Imagine a massive boulder resting precariously on the very edge of a high cliff.
Okay, I'm picturing a giant, heavy stone balanced hundreds of feet up.
Right. In physics, that boulder possesses enormous potential energy simply because of its mass and its height. But it hasn't actually done any work yet. It is just sitting there,
waiting to fall.
Paper wealth in an equity portfolio, the numbers you see when you log into your brokerage account, that is the boulder on the cliff. It is potential energy.
So when does it become real energy?
It only becomes actual kinetic energy, actual money you can spend on groceries or a mortgage at the moment of the conversion event.
And the conversion event is when I hit the sell button on my trading app.
The sale is the conversion event. But here is the terrifying catch that the illusion hides. The conversion event depends entirely on there being a willing buyer waiting on the other side of that button.
Someone ready with cash.
Exactly. Willing to pay the exact price you see on your screen.
I see where this is going. And if everyone looks at the dissolving foundation of the economy and decides they want to sell their boulders at the exact same time?
The buyers vanish.
Right.
And when buyers vanish in financial markets, prices don't just slowly decline, they gap down instantly.
Just a free fall.
The market makers lower their bids dramatically to find where the demand actually is. That potential energy converts into far less kinetic energy than the paper value suggested.
So the wealth was never really there.
The Federal Reserve's data notes that the richest 10% of American households now hold over 2/3 of the nation's total wealth. But the word hold is doing a lot of heavy lifting.
Because it's all just paper.
It is unrealized equity. It is paper that hasn't moved.
Yeah.
If a panic hits, or even just a massive demographic retirement wave where millions of boomers try to convert their portfolios simultaneously, the illusion shatters.
That makes sense fundamentally, but what is keeping the boulder so high up on the cliff right now? If the labor market is softening, why are the valuations of these tech companies astronomically high in the first place?
The mechanism driving the boulder up the cliff is index concentration. Right now, the entire stock market is essentially being carried on the backs of just a handful of companies, known as the Magnificent Seven.
And who are they?
We are talking about NVIDIA, Microsoft, Apple, Amazon, Google, Meta, and Tesla. As of 2026, these 7 companies account for approximately 1/3 of the entire S&P 500 index.
1/3. But wait, I thought the whole point of buying an S&P 500 index fund was to be diversified across 500 different sectors and companies. That's what every financial advisor tells you.
That is how it was originally marketed.
Okay.
But we have to look at the mechanics of how these standard index funds operate. They are capitalization weighted.
Meaning what?
That means the bigger the company gets in terms of market value, the larger percentage it takes up in the index. So as these 7 tech giants grew, the index algorithms automatically allocated more and more capital to them.
Okay.
If you buy a standard S&P 500 fund today, you're mechanically forcing 33 cents of every single dollar you invest into just those 7 companies.
Without even realizing it.
Whether you intend to or not. Whether you think their current price is justified or not.
So passive investing, which was supposed to be the safe, smart, hands-off approach for the average person, is actually just a blind algorithm funneling money into a highly concentrated tech oligopoly.
It is blind momentum investing. Fortune magazine pointed this out bluntly in February 2026. They noted that the Magnificent Seven have made index funds riskier than they have been in years.
Because all your eggs are in one basket.
They have lost their primary value as a diversified cushion against sector-specific shocks. And because of this blind mechanical buying where millions of 401ks auto-deposit every 2 weeks and buy regardless of price, these stocks are trading at absurd valuations.
How absurd are we talking? Like, give me a number.
Well, in early 2026, their price-to-earnings ratios, the PE ratio, which measures how much you pay for $1 of corporate profit, ranged from 25 times earnings for Microsoft to over 400 times earnings for Tesla.
400 times earnings.
Most are sitting well above 28 times earnings. These are historically stretched valuations driven not by fundamental business growth, but by forced buying.
And it feels like the traditional safety valve is missing here. Shouldn't active fund managers be looking at a stock trading at 400 times its earnings and saying, this is fundamentally ridiculous, I'm selling to protect my clients?
They should. Active price discovery is the historical correction mechanism of a healthy market.
Right.
But that mechanism has weakened critically because passive index investing has largely displaced active management over the last decade.
There's no one at the wheel.
There is simply less active capital pushing back against the inflated prices. The machine just buys because the rules of the index say it has to buy.
It feels like a massive structural loophole. But wait, if this mechanical buying is indiscriminately soaking up the existing tech giants, what happens when new giants try to enter the market?
That is the big question.
Because I keep reading about some massive private AI companies that are gearing up to go public.
This is where the structural trap really closes on the retail investor. We have to examine the mechanics of the 2026 mega IPOs.
Okay.
There are 3 massive companies entering the public markets in a very compressed 6-month window from June through December of 2026.
Which companies are we talking about?
SpaceX, OpenAI, and Anthropic. SpaceX filed its public documents in May 2026, aiming for a NASDAQ listing at a valuation of approximately $1.75 trillion.
Trillion with a T.
Trillion. Looking to raise up to $75 billion from the public.
Wow.
OpenAI is targeting the 4th quarter of 2026 at roughly a $1 trillion valuation. And Anthropic is looking at October 2026 at about $900 billion, trying to raise over $60 billion.
Trillions. We are throwing around trillions like it's pocket change.
Let me contextualize how massive this capital demand actually is.
Yeah.
Total U.S. IPO fundraising for the entire year of 2025 across all companies was about $45 billion.
For the whole year.
For the whole year. The combined capital raised from just these 3 companies in a 6-month window is conservatively estimated at over $200 billion.
That is insane.
That exceeds every single venture-backed U.S. IPO combined since the year 2000.
Okay, that is an incomprehensible amount of money to pull from the market at once. But surely they are incredible businesses, right? I mean, OpenAI is generating billions in subscription revenue from ChatGPT right now. Everyone I know pays $20 a month for it. How can you say they aren't worth it?
Revenue is not profit.
Fair point.
And this is a critical distinction in finance. Yes, OpenAI has massive top-line revenue. But the mechanics of generative AI require an astronomical compute cost.
The servers and the power.
The electricity, the specialized cooling facilities, and most importantly, the constant purchasing of NVIDIA GPUs just to train the next generation of models. Their burn rate is historic. None of these 3 companies, SpaceX, OpenAI, or Anthropic, is currently generating a net profit.
Wait. They want to raise more money than every IPO in a quarter of a century combined. They are demanding valuations in the trillions, and they are mathematically bleeding cash.
That is the reality. And the institutional response to this offering has been incredibly telling.
What are the big players doing?
Bloomberg reported that after the underwriters contacted hundreds of major institutions, we are talking about sophisticated pension funds, university endowments, sovereign wealth funds, not a single one was willing to commit to buying OpenAI at its current private market pricing.
Not a single one. Because the institutions have dedicated risk analysis teams. They look at the burn rate, they look at the math, and they say, we aren't paying $1 trillion for a company that might never figure out how to make the compute costs sustainable.
Exactly. The sophisticated buyers, the smart money, passed on the deal.
Okay, so if the institutions refuse to buy it, the crucial structural question becomes, who absorbs all this overvalued equity? The venture capitalists who funded these companies early on want their exit. So who is the buyer of last resort?
Well, who do you think?
Let me guess. The passive index funds.
It is the passive index funds, and it happens through a very specific mechanism called the fast entry trap.
Fast entry trap. Explain that to me.
Effective May 1st, 2026, NASDAQ implemented a new rule. Historically, a company had to trade for a while, show stability, and meet certain seizing requirements before being added to a major index.
Like they had to prove they were a real functioning company first.
Right. But under the new rule, if a newly public company has a market capitalization large enough to rank at the top 40 of existing NASDAQ 100 components, it can be added to the index within just 15 trading days of its IPO.
15 days.
And the S&P Dow Jones Indices is considering a similar fast-track rule, waiving their usual 12-month seasoning and profitability requirements entirely.
So wait, let me get the mechanics of this straight. If I have a 401k that blindly tracks the NASDAQ and OpenAI IPOs, my index fund doesn't have a choice.
It is legally required by his own prospectus to buy the stock.
Oh my God.
Remember, index funds do not analyze business models, they don't evaluate PE ratios, they don't care about the GPU burn rate, and they don't look for profitability.
They just follow the list.
If the stock is added to the index, the fund must buy it in exact proportion to its index weight. The passive retail investor will automatically own SpaceX, OpenAI, and Anthropic within weeks of their listings at whatever inflated price those stocks are trading at on day 15. There is no opt-out.
Let me try an analogy here. This sounds like being at a restaurant with a huge group of friends where you all agreed beforehand to split the bill evenly.
I like this.
And right before the check comes, the richest guy at the table orders a $10,000 bottle of wine. Because of the rules of the table, you are legally required to chip in and pay for it, even though you didn't order it, you didn't want it, and you can't afford it.
That is exactly how fast entry works. And the hedge funds know this.
They exploit it.
Absolutely.
Yeah.
Let's look at how the market makers exploit this mechanic. When NASDAQ announces that a mega-cap company is going to be added to the index on day 15, active traders and hedge funds buy the stock aggressively on days 1 through 14.
They front-run it.
They front-run the inclusion. This drives the price of the stock up to the sky. Then, on day 15, the massive Vanguard and Fidelity index funds are forced to buy billions of dollars of the stock at that artificially inflated peak price.
And the hedge funds just sell it to them.
The hedge funds sell to the index funds and pocket the difference.
That feels like a massive structural loophole. How is that even legal? Early venture capitalists and Wall Street hedge funds are essentially using the mechanical rules of passive indexing to force everyday retail investors to hold their bags.
It is a systematic structural transfer of wealth. It is entirely legal, and it is completely invisible to the person experiencing it.
Because they just see an auto deposit in their 401k.
Right. The retail investor never reviewed an IPO prospectus, never analyzed the compute costs on the balance sheet, and never made an active choice. The system makes the choice for them.
And where does all that capital even come from? I mean, if $200 billion is suddenly sucked into these three companies by forced index buying, does it just materialize out of thin air?
No. Capital is finite. The money rotating into SpaceX, OpenAI, and Anthropic has to come from somewhere.
Where?
And that somewhere is the existing stock market. To buy the new heavyweights, index funds have to mechanically sell fractions of their positions in the other 497 companies to rebalance the portfolio.
Oh, wow.
Wall Street analysts are calling it a super liquidity drain. It is a massive headwind across the entire broader financial market. Capital is being drained from the wider economy just to fund a few unprofitable tech monoliths.
Which brings us to the macro environment. We have this teetering boulder of paper wealth propped up by blind mechanical buying and fast entry traps.
And it needs perfect conditions to stay up there.
Right. For it to stay perched on that cliff, it requires near-perfect economic conditions. Earlier, you mentioned interest rates acting as a vice grip on these tech valuations. I really want to understand the math here.
Let's break it down.
How exactly do interest rates mathematically destroy high stock prices?
If we connect this to the bigger picture, to understand the gravity that eventually brings that boulder down, we have to look at the mechanical relationship between bond yields and equity PE ratios.
Okay.
A share of stock It's essentially just a legal claim on a company's future earnings.
Mm-hmm.
But fundamentally, money tomorrow is not worth the same as money today.
Because inflation eating away at its value, right? And because you could just put the money in a safe bank account today and earn interest on it instead.
Correct. To value a stock today, financial models discount those future corporate earnings back to a present value. And the interest rate on safe government bonds is used as the discount rate.
Okay, I'm following.
When interest rates are sitting near zero, like they were for the past decade, future money is worth almost exactly the same as present money. So investors are perfectly happy to pay a massive multiple today for profits that might not arrive for 10 years.
Because there's no safe alternative yielding anything anyway. I mean, a bond paying 0.5% is basically dead money.
Right. But when interest rates rise, the math violently reverses. Let's walk through a concrete example from the source data. Imagine a solid company earns $10 per share in profit, and its stock trades at $200.
Okay, let me do the math. 200 divided by 10 is 20. So the PE ratio is 20.
Yes. Now let's look at the earnings yield, which is just the inverse of the PE ratio. It tells you what kind of return the business is generating on its stock price.
Okay, inverse. So 10 divided by 200, that's 0.05 or a 5% yield.
Exactly. The stock essentially yields 5%. Now, if the safe, risk-free 10-year Treasury bond is only paying 1.5%, a 5% stock yield looks fantastic.
Yeah, that's a big difference.
The gap between the two, what we call the equity risk premium, is a healthy 3.5 percentage points. Investors feel well compensated for taking on the volatility and risk of owning the stock instead of the safe bond.
But what happens to the math when the safe Treasury bond rate shoots up?
When the safe Treasury rate rises to 4.5%, that 5% stock yield suddenly looks terrible.
Oh, right, because they're almost the same.
The risk premium shrinks to just 0.5 percentage points. Why on earth would an investor take the risk of owning a volatile stock for a tiny extra 0.5%?
They wouldn't.
They won't. The market will demand a higher yield from the stock to justify the risk. Let's say they now demand a 6.5% yield to maintain a decent premium over the bond.
But the company is still only earning $10 a share. They didn't magically get more profitable overnight just because bond rates change.
The earnings didn't change at all. So if the market demands a 6.5% yield and the earnings are fixed at $10, the stock price mathematically must crash.
It has to.
It has to drop from $200 down to $154. Nothing changed at the company itself. Their product is the same. Their management is the same. Their revenues are the same. But the interest rate environment changed, and the stock loses nearly a quarter of its value instantly to adjust to the new gravity.
Wow. And that's for a mature company that actually has current earnings. What about these AI companies and mega IPOs that have zero profits and are banking entirely on a narrative of massive profits in 2032 or 2035?
For them, the duration math is absolutely devastating. Because their theoretical profits are so far out in the future, each single percentage point increase in interest rates dramatically reduces the present value of those distant earnings.
Oh, man.
A company dependent entirely on 2035 theoretical cash flows loses a vastly larger fraction of its present valuation to every rate hike than a company earning hard cash today. They are hypersensitive to interest rates.
Here's where it gets really interesting. These tech valuations are highly fragile, perched on this cliff of passive buying, completely exposed to the gravity of rising interest rates.
Very exposed.
Which means the entire system hinges on keeping interest rates low. But what is happening in the real world right now? Let's look at the exact real-world sledgehammer that is currently hitting the cliff face. You mentioned severe macro shocks.
Real-world events are currently shattering the assumption of low interest rates. We are facing a perfect storm of oil supply collapse, sticky inflation, and relentless interest rate pressure. The boulder is being pushed.
Let's start with the oil shock. The source text mentions a massive disruption in the Middle East. Walk me through the mechanics of what exactly happened with the Strait of Hormuz. Why does one waterway matter so much?
Geography dictates global economics. The Strait of Hormuz is a narrow choke point between the Persian Gulf and the Gulf of Oman. A massive percentage of the world's oil simply has to pass through it.
Okay.
In late February 2026, an outbreak of conflict involving U.S., Israeli, and Iranian forces effectively closed the strait to commercial shipping.
Closed it completely.
The impact was immediate and catastrophic. Ship transits through that crucial choke point dropped from about 130 per day in February to just 6 per day in March.
That's a 95% drop. Almost nothing is getting through. But why can't the ships just go around?
They can't just go around because of where the oil fields are physically located inside the Gulf.
Oh, right.
Even for ships coming from other regions trying to avoid the conflict zone, rerouting is a nightmare. Maritime insurance premiums spiked so high that shipping companies refused to sail. If a supertanker has to reroute around the entire Cape of Good Hope at the bottom of Africa, it adds 3 to 4 weeks to the journey.
Which means they burn massive amounts of extra fuel just to make the trip, and it completely breaks the math of global just-in-time delivery.
Exactly. The supply chain relies on precise timing. The International Energy Agency characterized it as the largest supply disruption in the history of the global oil market.
History. That's a strong word.
Over 10 million barrels of oil per day simply vanished from the global supply chain. In response, Brent crude oil surged approximately 65% in a single month. It was the largest monthly price spike ever recorded.
And oil is in everything. It's not just the gasoline you put in your car. It's the diesel for the trucks delivering groceries to the supermarket. It's the jet fuel for global cargo. It's the core raw material for plastics, pharmaceuticals, and agricultural fertilizers.
It is the foundational input of the modern industrial economy. The economic costs are compounding daily. By day 42 of the closure, economic models were projecting a severe global GDP impact of between 2.19 and 4.38%.
That's recession right there.
The direct costs to Gulf states and Iraq alone are roughly $1.1 billion per day in lost revenue. And because it hit crude oil, liquefied natural gas, fertilizer, and refined products simultaneously, the shock cascades through every sector.
Which leads us directly to inflation. If energy prices jump 65%, the cost of manufacturing and transporting everything else has to get more expensive.
And the data shows it is. As of our current date, June 10th, 2026, the May Consumer Price Index inflation data just hit 4.2%.
Yikes.
That is the highest annual rate since April 2023, and it marks the third consecutive month of acceleration. Energy costs jumped 23.5% year over year. Gasoline alone is up 40.5% annually, and fuel oil is up an incredible 58.9%.
So it's mostly energy driving it.
Energy accounted for over 60% of the entire CPI increase in May.
But the Federal Reserve and the financial media always talk about core inflation, right? They like to strip out volatile things like food and energy to see the underlying trend. Surely that core number looks a bit better.
It really doesn't. Stripping out the energy shock, core inflation reached 2.9% annually, which is the highest since September 2025.
Oh.
And the most dangerous, heavy component of core inflation is shelter. Shelter inflation, which includes rent and homeownership costs, makes up more than 1/3 of the total CPI weighting. It is currently running at a highly sticky 3.4% and accelerating.
And housing costs don't care about the price of oil in the Strait of Hormuz.
Exactly. Shelter inflation does not respond to oil prices or quick supply chain fixes. It responds to structural housing supply, which takes years of permitting, zoning, and physical construction to adjust.
So it's not going anywhere soon.
It is incredibly sticky and painfully slow to reverse. The Federal Reserve has a stated non-negotiable target of 2% inflation. Right now, both the headline number and the core number remain stubbornly above that target, with absolutely no clear near-term path to resolution.
So if inflation is roaring like this, the Federal Reserve has to keep interest rates high to fight it, right? They can't lower rates to help the tech stocks without pouring gasoline on the inflation fire. What is happening in the bond market as a result?
The bond market is under immense pressure. The 10-year Treasury yield hit 4.6% in May 2026, which was the biggest weekly jump since the tariff shock of early 2025.
Huge jump.
The longer-dated bonds are selling off the hardest because they are the most vulnerable to long-term entrenched inflation. The Fed is holding its policy rate between 3.5 and 3.75%.
Which hurts the tech stocks.
Yes. Earlier this year, Wall Street was entirely pricing in the assumption that the Fed would cut rates multiple times to support the market. Now, they are projecting only one possible cut in all of 2026, and the market is pricing in a 48% chance that we get 0 cuts this year. People are even whispering about the necessity of rate hikes for 2027.
But wait, the U.S. government has massive historic debts. Doesn't the Fed control the interest rates? If things get bad, can't they just step in, print money, and force the rates down to help the stock market like they did during COVID?
This is perhaps the most crucial point in the entire macro picture. The United States no longer completely controls its own destiny regarding interest rates.
Say that again.
Multiple independent global forces are driving yields higher. completely outside of the Federal Reserve's control.
How is that possible? I thought the Fed was all-powerful in the bond market.
Look at the mechanics of foreign debt ownership. Historically, countries like Japan ran massive trade surpluses and used those dollars to buy U.S. treasuries. Japan is currently the largest foreign holder of U.S. debt. They hold about $1 trillion worth.
Okay, $1 trillion.
But Japan imports nearly 90% of its energy.
And global oil is priced in U.S. dollars.
Exactly. Because oil is priced in U.S. dollars and the price of oil just skyrocketed 65%, Japan suddenly needs a massive amount of U.S. dollars just to keep the lights on and their factories running.
Oh, wow. How do they get those dollars?
They have to sell off their U.S. Treasury holdings on the open market.
So Japan is dumping U.S. bonds to survive the oil shock.
Yes. And at the exact same time, the Bank of Japan is tightening its own domestic monetary policy to fight their own inflation, driving Japanese government bond yields to their highest levels since the 1990s.
Oh, so the money goes back home.
So for the first time in decades, Japanese institutional investors finally have a competitive domestic alternative to U.S. treasuries. All this foreign selling floods the global market with U.S. bonds.
And supply and demand takes over.
Right. When supply floods the market, the price of the bond crashes, and the yield mathematically goes up.
And let's not forget the domestic side. I mean, the U.S. national debt is sitting at $39 trillion. The Treasury Department has to constantly issue new bonds every single month just to fund our own government deficit, which adds even more supply pressure to a market that already has way too many sellers.
Precisely. All of these forces, inflation, massive government issuance, and foreign liquidation, are jacking up interest rates naturally. The Fed can do absolutely nothing to stop it without triggering a massive currency crisis.
So we have an inescapable squeeze. It feels like a household budget completely imploding. It's like you're trying to manage your family finances, but the mortgage rate, which is the Treasury yields, is spiking. The grocery bill inflation is spiking, and the heating bill oil is spiking simultaneously.
It's all hitting at once.
And this squeeze drains all the available capital and liquidity out of the broader economy, which is the very liquidity needed to keep the tech stock boulder propped up on the cliff. It is a textbook definition of stagflation risk, isn't it?
It is the essence of stagflation. The combination of high inflation from the oil shock and slowing economic growth from the AI labor displacement creates a brutal environment.
And in stagflation, the central bank is trapped.
If they cut rates to stimulate the slowing labor market, they risk accelerating the already red-hot inflation.
Well,
but if they raise rates to kill the inflation, they risk tipping the fragile, slowing economy into a deep, painful recession. So they are frozen in a wait-and-see posture.
Which just prolongs the pain and keeps those rates high, keeping the gravitational pressure on the tech stocks. This feels like an unprecedented perfect storm. We have revolutionary technology displacing workers, wild financial speculation forcing massive overvaluation, and uncontrollable macro crashes happening all at once.
It's a lot.
Has anything like this intersection of transformative technology, financial mania, and structural economic collapse ever happened before?
It has. History doesn't repeat, but it rhymes. And understanding that history provides us with a clear, actionable blueprint for what happens next.
Oh, I like a blueprint. What's the historical parallel?
The closest historical parallel to the current AI equity situation is the railway mania of the 1840s through the 1870s.
The railroads, okay, I can see the comparison. Railroads were a genuinely massive technological leap. They weren't a fake product. They completely changed how human beings lived, communicated, and traded.
Exactly. They were genuinely transformative. They created national markets out of isolated towns, enabled mass migration, and physically compressed the continent. The technology was absolutely real, and the long-term societal value was undeniable.
Right.
AI is real in the exact same way. But the financial investment mania that accompanied the railroads was completely decoupled from the economic reality of the time.
How big was the bubble? Like, give me a sense of the scale.
In the UK, railway mania reached its absolute zenith in 1846. In that single year, 263 separate acts of parliament were passed specifically to authorize the creation of new railway companies.
263 in 1 year.
And the bubble was fueled by the exact same things driving our AI bubble today: easy money and leverage. The Bank of England had aggressively cut interest rates in the early 1840s, lowering financing costs and making speculation incredibly cheap.
Sounds exactly like the zero interest rate environment we had leading up to the AI boom.
It's the same mechanic. And there were structural traps, too, very similar to our modern margin trading. Back then, you could buy railroad stock with just a 10% deposit.
Wow, 10% down.
That massively expanded the investor base, pulling in everyday people who who really couldn't afford the full risk exposure. One observer from the time wrote that the contagion spread to all from the clerk to the capitalist. The fever reigned uncontrollable and uncontrolled.
So everyone thought they were getting rich on paper. They were all staring at their own boulders on the cliff. But how did it end? What broke the illusion?
Overbuilding and the harsh realization that the fundamental economics didn't support the massive debt. In the United States, this culminated in the Panic of 1873.
What happened in 1873?
Let's look at the mechanics of a major financial firm called J. Cook & Company. They had become the government's primary agent in financing railroad construction after the Civil War. They laid 35,000 miles of new track between 1865 and 1873.
That's massive infrastructure.
The railroad industry became the largest non-agricultural employer in the whole country. The eastern financial markets and the railroads grew up intertwined, much like Silicon Valley and Wall Street today.
How did J. Cook actually fund all this?
They needed massive capital, so they couldn't just rely on rich tycoons. J. Cook used a network of traveling salesmen and patriotic post-war pitches to sell railroad bonds directly to everyday retail investors.
Like farmers and merchants.
Farmers, merchants, small savers. They built a massive distribution channel to funnel retail savings into speculative infrastructure.
So what triggered the crash?
The smart money realized the math was broken. When it became obvious that they had vastly overbuilt, that there weren't enough paying passengers or freight to justify the immense debt of all these competing lines, the sophisticated European institutional investors stopped buying.
They saw the writing on the wall.
They looked at the equivalent of the AI compute burn rate, and they backed away. They started dumping their railroad bonds in the spring and summer of 1873. J. Cook couldn't find enough buyers to refinance their short-term debt.
So what did they do?
By September 18, 1873, J. Cook & Company completely collapsed.
Just bankrupted overnight.
Yes, and the consequences were catastrophic for the broader economy. 89 of the country's 364 railroads instantly crashed into bankruptcy.
89 of them.
Over 18,000 businesses failed over the next 2 years as the contagion spread. Unemployment surged to 14% nationally and hit a staggering 25% in New York City.
A quarter of the city out of work.
The New York Stock Exchange actually had to close its doors for 10 straight days just to stop the bleeding and prevent a total systemic collapse. The Panic of 1873 was so severe that at the time, it was known as the First Great Depression. It lasted for more than 5 painful years.
And we're seeing the exact same dynamic today. The S&P 500 hits record highs, enriching the top 10% who own 2/3 of the wealth, while the bottom third of the economy is being squeezed by inflation and a softening labor market. The source text calls this a K-shaped economy.
Yes. In a normal economic recovery, it's shaped like a V or a U. Everyone goes down together, everyone comes back up together.
Right.
In a K-shaped economy, the paths diverge violently. The top arm of the K shoots upward. These are the asset holders capturing the paper gains of the Magnificent Seven.
And bottom arm.
The bottom arm of the K plummets downward. These are the wage earners facing displaced entry-level jobs, 4.2% inflation, and sticky housing costs.
That divergence is scary.
Bank of America actually looked at real credit and debit card transaction data in mid-2025. It showed that spending by the lower third of cardholders actually shrank and stayed flat into early 2026, while the upper income brackets kept spending wildly.
Income inequality is now near a 60-year peak. We are a totally fractured economy.
We really are.
So what does this all mean? If the railroad bubble gives us the blueprint for the K-shaped crash, it must also give us the blueprint for who survived it, right? I want to know who walked away from the Panic of 1873 with their shirts on.
Better than just surviving, some built historic fortunes. The railroad bubble produced 3 archetypal roles that repeat in every single major technology bubble.
Break them down for me. Who were the 3 players?
The first role is Andrew Carnegie. Carnegie recognized the bubble, but he didn't try to guess which specific railroad company would win the geographic wars.
He didn't pick the winning train.
Instead, he sold steel rails to all of them. He produced the fundamental physical input that every single railroad required to operate, regardless of whether they ultimately went bankrupt or dominated the market.
Brilliant.
He collected his cash at every transaction. His revenue came from the reliable, unglamorous infrastructure layer, safely beneath the wild speculation. So when the bubble burst and 89 railroads went under, Carnegie was perfectly fine. He already had their money.
So who plays the role of Carnegie today?
Today, Andrew Carnegie is NVIDIA. They are selling the GPU chips to every single AI startup, regardless of who wins the language model wars.
Right.
or it's the industrial power companies supplying the massive amounts of electricity required for the data centers.
That makes total sense. Own the picks and shovels during a gold rush.
Okay, who is the second archetype?
The second is Jay Cooke. This is the tragic role.
The bankrupt guy.
Jay Cooke was the final distribution channel. When the sophisticated institutional money in Europe realized the railroads were overbuilt and stopped buying the bonds, Jay Cooke kept pushing them.
And who did he sell them to? The retail investors. He became the mechanism by which early-stage institutional capital was transferred to late-stage retail holders at the absolute peak prices. When the crash hit, the retail holders absorbed the massive, devastating losses.
Wow. And today, Jay Cooke is the IPO underwriters and the index fund designers using the fast entry rules. They are the ones taking overvalued private companies like SpaceX and OpenAI and mechanically dumping them onto passive retail 401k holders after the sophisticated institutions have already passed on the deals.
That's the core of the issue. They legally facilitate the exit for the insiders at the expense of the blind indexer.
Okay, and the third archetype, the one who actually made the real money from the crash itself.
That is Cornelius Vanderbilt. Vanderbilt understood two things with absolute clarity. The railroad technology was real and would change the world, but the current stock prices were dangerously wrong.
So he didn't play the pure speculation game?
He didn't. He built massive liquidity during the mania, he stayed safe, and then he patiently waited for the inevitable crash.
And then what?
When it happened and panic set in, he deployed his liquid cash to buy up incredibly valuable, distressed railroad infrastructure for mere pennies on the dollar.
Because no one else had the money.
Exactly. He scooped up the bankrupt lines, consolidated them into massive, efficient networks, and built the greatest individual fortune of his entire era. He didn't try to predict the exact day the market would crash. He just preserved his capacity to act when it did.
So, knowing we are in the middle of a deeply fractured, K-shaped economy and watching this exact historical pattern repeat in real time with AI and Wall Street, what exactly can the listener do right now? How do we be a Vanderbilt instead of becoming Jay Cooke's next victim? I am sufficiently warned. I want to be a deliberate actor here. Walk me through the actual, practical, strategic framework for navigating the wealth trap.
The practical playbook requires actively removing yourself from the mechanical passive traps and taking very deliberate positions. The first part of the strategy is establishing the Carnegie position.
Right, owning the infrastructure. What does that look like in a modern portfolio?
It means you stop betting on whether OpenAI's language model beats Anthropic's or whether Google's AI search beats Microsoft's. You move your capital to the foundational layer that gets paid regardless of who wins the software war.
Like the chips.
You buy the semiconductor manufacturer supplying the training chips. You look at data center real estate investment trusts, the REITs that actually own the physical buildings, the cooling systems, the fiber optic lines, and lease that physical space to these tech giants.
That's smart.
You invest in the power and grid infrastructure companies because these data centers are consuming electricity at unprecedented rates. And you look at cybersecurity firms that have to protect all of this new infrastructure.
And the crucial difference is that these companies actually make real money right now.
Yes. These companies have real, current earnings and strong cash flow. They do not require some theoretical, fantastical narrative about profits in 2035 to justify their stock prices today. They are selling the steel rails today.
Okay, that covers the equity side. What about the Vanderbilt strategy? How do we build that liquidity without just sticking cash under a mattress and letting 4.2% inflation eat it alive?
You establish the Vanderbilt Reserve. This is a very deliberate allocation to highly liquid, short-duration instruments.
Okay.
The key is that you hold them specifically to deploy during the severe correction that follows the bubble. It is vital to understand the psychology of this. It is not a safety fund for emergencies, and it is not idleness. It is positioned waiting.
Positioned waiting. I like that phrase. It implies readiness, not fear.
Exactly. Right now, short-term Treasury bills are yielding over 4%. That is real, guaranteed money. It ensures principal preservation, and it offers nearly instant liquidity. Money market funds with government-only mandates serve the exact same function.
But I imagine the psychology is brutal. When your neighbor is bragging about their tech stock going up 20% in a month, holding a 4% T-bill feels like you're losing the game.
It is the hardest part of the strategy. Watching the mania unfold and feeling like you are holding dry powder that isn't doing anything exciting is psychologically taxing. The fear of missing out is a powerful force.
Oh, absolutely.
But Vanderbilt's core insight was that, true, generational wealth is not made during the final stages of a mania. is made at the precise transition point from mania to correction.
Right.
At that moment, the only thing that matters in the world is who has the liquid cash to act while everyone else is forced to sell at fire sale prices to cover their margins.
Let me ask a technical question about the bonds. If I want to hold safe government bonds, why not just buy the 10-year or 30-year Treasury bonds? If rates are high right now, shouldn't I lock them in for a long time? Why specifically short-term bills?
This raises an important question about duration management. The absolute core rule of bond mathematics is this. When interest rates rise, existing bond prices fall. They move on a seesaw.
A seesaw.
Long-duration bonds, the ones maturing 20 or 30 years from now, fall the most violently when rates rise.
Walk me through the mechanics of why they fall more.
Because your money is locked into that specific fixed interest payment for the longest amount of time.
Okay.
If you own a 30-year bond paying 2% and the market rate suddenly jumps to 5% because of an oil shock, nobody wants your old 2% bond unless you sell it to them at a massive, massive discount to make up for the yield they are missing out on.
Right, because they could just go buy the new 5% bond from the government. Why buy my bad one?
Precisely. But short-duration bonds, those maturing in 3 months or 6 months, are barely affected by rate hikes.
Why is that?
Because they mature and hand you your principal back before the rates can move significantly against you. Then you just take that full principal and reinvest it into the new, higher-yielding short-term bills.
Oh, that makes sense.
In our current environment, where we know yields are rising from foreign selling by Japan, persistent inflation, and massive government debt, holding long-duration bonds is incredibly dangerous. Moving to short duration protects your principal from the seesaw.
And what about the inflation piece of the puzzle? Even at 4% on a short-term bill, if inflation is running at 4.2%, you are still technically losing a tiny bit of real purchasing power every year.
Which is why the framework includes TIPS Treasury inflation-protected securities.
TIPS. How do those work?
TIPS are specifically designed by the government to address the inflation problem mechanically. The actual principal amount of a TIPS bond adjusts upward with the consumer price index.
Wait, explain how that works. So if the CPI says inflation is 4.2%, the core value of my bond goes up by 4.2%.
Yes, the principal adjusts. So your principal grows precisely with inflation, and then you earn a real fixed interest yield on top of that adjusted principal.
That's incredibly powerful.
Standard bondholders are currently watching their purchasing power erode in real terms. TIPS provide a guaranteed real return above inflation, rather than a nominal return that gets eaten by higher grocery and energy bills. It preserves your purchasing power mechanically.
Okay, that is incredibly tactical. But let's say someone listening still wants to be in the stock market. They still want broad exposure to the S&P 500, but they are terrified of the Magnificent Seven concentration, and they don't want to get caught in the fast entry trap of these new mega IPOs. What do they do?
The solution to the index trap is equal weight indexing.
Equal weight indexing.
Remember, the core problem with the standard S&P 500 fund is that it is cap-weighted. That is why 33 cents of every dollar gets sucked into just 7 companies. An equal weight index fund owns the exact same 500 companies as the standard S&P 500, but it deliberately allocates its money equally across all of them.
So every company gets the exact same slice of the pie, regardless of how big they are.
Exactly. In an equal weight S&P 500 fund, every single company gets approximately a 0.2% weighting. The Magnificent Seven, instead of taking up 33% of your money, collectively represent about 1.4% of the fund.
That is a massive difference in risk exposure.
It drastically reduces your vulnerability to the tech bubble bursting. Now, to be clear, it does not completely eliminate overall market risk.
Of course.
And during periods when a few large tech companies completely dominate the momentum, the equal weight fund will underperform the standard index. But historically, equal weight funds have provided far better diversification and often better long-term performance across full market cycles.
Why is that?
Because to maintain that equal weight, the fund has to periodically rebalance. It is forced to mechanically sell the stocks that have gone up the most and buy the stocks that have gone down. It forces you to buy low and sell high, rather than just blindly riding the biggest bubbles to the top of the cliff.
This entire framework, the Carnegie position for infrastructure, the Vanderbilt reserve for liquidity, short duration to avoid the bond seesaw, TIPS for inflation, and equal weighting to escape the index trap, it is a complete paradigm shift from the old blueprint. It requires you to stop being a passive passenger and grab the steering wheel.
It demands deliberate action. The wealth trap thrives on the passivity of its participants.
Which brings us to the end of our journey today. Let's pull this all together for you, our listener. We started by looking at a broken blueprint. We've seen the mechanics of how the career ladder, that crucial entry-level rung, has been ruthlessly pulled up by AI.
Shifting the burden of unemployment to white-collar knowledge workers in a way we've never seen, and creating a hidden shadow population of underemployed grads.
We unpacked the terrifying money illusion, where passive index funds are mechanically forcing your money into wildly overvalued tech stocks.
And how the fast entry trap allows hedge funds to use index rules to dump massive, unprofitable IPOs onto retail investors at peak prices.
We also looked at the inescapable vice grip of macro shocks, how the physical geography of the Strait of Hormuz bottlenecked oil, fueling sticky 4.2% inflation.
And how foreign nations like Japan are forcing our interest rates higher, systematically crushing the theoretical valuations of the tech market.
And we learned that this has all happened before. The railroad mania of the 1870s shows us exactly how a K-shaped crash plays out, but it also provides the exact blueprint for how to survive and thrive during the transition.
That's right.
Our mission today was to show you the gears of this machine so you don't get caught in them. You don't have to be Jay Cook's retail victim. You can choose to be Carnegie, holding the infrastructure. You can choose to be Vanderbilt, holding the liquidity.
The tools are available, but they require a conscious choice to step off the passive path.
And as we close, I want to leave you with one final, deeply provocative thought to mull over. We spent this whole time talking about artificial intelligence as this flawless, hyper-rational, calculating force that is so efficient, it is displacing human labor across the economy.
Yeah.
But consider the ultimate dark irony of this entire era. The expansion of this hyper-rational AI system is entirely 100% dependent on the most deeply irrational, emotional, and blind market behaviors humanity has ever invented. It depends on passive index buying without any analysis and wild retail mania driven by the fear of missing out. If AI is truly as intelligent as they say, perhaps the first thing it disrupts isn't just your job or your career ladder. Perhaps the very first thing it destroys is the fragile, irrational financial system that is currently funding it.
That's quite the thought.
If the machine is eating its own fuel line, eventually the engine stops. Stay curious. Review your own positions. Look at your own blueprint. And decide right now, before the boulder falls off the cliff, which historical archetype you want to play. Thank you for joining us on this deep dive.